This video describes Bayesian models of expected return and tries to explain how we can go about finding the future expected return using a Bayesian process. Okay, what is the basic form of a Bayesian process? You start with the prior about the value to be estimated. So in this case, we're trying to estimate the expected return. So you start with the prior, and a prior is just some previous information that you have about that particular thing you're trying to predict, and then you use that prior along with empirical data. Okay, so the prior is updated by empirical data, and then the posterior value is generated. Okay, what's the posterior value? Something that comes out after you use the prior with the empirical data. Okay, the posterior value then is a mixture between the prior and the mean of the empirical data. Okay, so we take a prior, which is some previous belief, we add in some data, we update all our models, and then we obtain a posterior, which is what we're going to use to forecast future values. Okay, so this process actually shrinks the estimated mean of the data towards the prior. Okay, we're combining both the mean of the empirical data with prior beliefs, and we update our model, and that sort of shrinks the mean towards the prior. Okay, what could we use as a common sense prior when we're trying to estimate future expected returns? Okay, we could assume, we already just talked about it, that stocks provide a higher risk stocks have a higher risk premium than bonds. Okay, we have this information. So if we're comparing just a T-bill, and we compare a long-term corporate bond versus a stock, okay, we know that the stock is going to have a higher risk premium because the stocks have a higher risk than a bond. Okay, so we could use that as some prior information with which to estimate our model. Okay, so the assumption that stocks provide a higher risk premium than bonds could be the prior that we use. Then add in our data, update that information to obtain a posterior. So what is estimation risk? So if we think about it, when we're trying to estimate expected returns from data, regardless of how long that information lasts, the mean is always estimated with some statistical error. So we cannot generate the mean of the data perfectly. There will always be some statistical error in the estimation process. Okay, the fact that expected return is not known accurately adds to the risk faced by investors. Okay, so investors have an extra risk from the fact that just the estimation might have a problem. Okay, this leads them to choose portfolios that are more conservative in the sense that they're making smaller investments in risky assets because there's already some risk in the estimation process. Okay, than if they were to ignore that uncertainty in the value of expected returns. Okay, if the expected returns were estimated perfectly, then investors would be picking less conservative portfolios. Okay, so this additional risk that comes in just from the estimation process, from finding the mean off the data itself, is called estimation risk. Okay, one interesting baseline for input estimation, so we talk about it back to a Bayesian sense if we're trying to minimize this estimation risk. We talked about the common sense prior, which could be, hey, the stocks have a higher risk premium than bonds. But let's say we just assume that we know nothing. Okay, we assume that we know nothing about the risk, return, and covariance of the different asset classes, and we're going to use that as our baseline, as our prior. Okay, if we start with that, if we have no statistical data to update the beliefs about our expectations, then the optimum portfolio is just going to be one that equally allocates weights. Okay, the equally weighted portfolio. Okay, the equally allocate weights among all asset classes. So if our portfolio has n asset classes, if we're talking about an equally weighted portfolio, each asset's weight is then going to be 1 over n. So if we have 3 asset classes, let's say international stocks, domestic stocks, and bonds, and we want to allocate our funds equally among those 3 without any past information, we're going to put a third into bonds, a third into domestic stocks, and a third into international stocks. Okay, that's the 1 over n. So basically, what is this assuming? It says if you know nothing about investments, then naive diversification should reduce risk. Okay, and some researchers then compared to try and find out how this portfolio performs relative to other models used to generate portfolios, and they actually found that the 1/n portfolio actually performs surprisingly well. Okay, especially for small sample sizes. Okay, it does better than other approaches, including the use of historical inputs to predict that optimal portfolio. Okay, so doing naive estimation with no information at all actually does quite well. Okay, and it does better than using the historical data. So again, we're coming to that general consensus that we've been developing over time, that even when we come up with all these brilliant models, something as simple as just dividing your money equally among all the assets might actually work out well in your favor, okay, especially if you have small sample sizes. So that leads us to the next topic, which is called the recovery theorem. Okay, so far all we've been talking about is using past information, using past data, using past. Okay, the problem with using historical data to estimate expected returns is that it's a backward-looking exercise. Okay, we're always looking at something in the past and trying to say the future could depend on something in the past. Okay. Well, we have some assets that actually depend on things in the future. Okay, they're forward-looking information. So why not try to use forward-looking information to predict our future values? Okay, what kind of forward information could we have? They're derivatives, right? We've just talked about derivatives like options and such things. So what does an option depend on? The value of the option depends on future expectations of that underlying asset, right? What do we believe is going to happen to that stock if we've bought an option on a stock? Okay. So one can gain a measure of the market's expectations of future returns based on prices of options and other derivative securities whose payoffs depend on what happens to the market in the future. Okay, so in theory, yes, that's a great idea. Why not use something that depends on values in the future to predict what our expected returns are going to be in the future? The issue is that it's not that simple. Okay, the price on these securities not only depend on the probability of future and good outcomes, future good and bad outcomes of the market, but it also depends on how risk averse the market was or is in valuing these securities. Okay, so if there's a high risk aversion, the value given to the option price might actually change relative to if there was low risk aversion. Okay, that's sort of implicitly brought into the pricing of the options and other derivative securities. So we need a way to disentangle the probability of future market movements from the degree of risk aversion in the market. Okay, how do we separate these two factors? So Stephen Ross, a researcher in 2011, came up with a way to disentangle these two factors, which is the degree of risk aversion and the probability of future market movements. Okay, so that process of recovering the market probabilities from the prices at which the derivative securities trade at is called the recovery theorem. Okay, that's referred to in his 2011 paper. And that's cited in the textbook as well. So it's kind of complicated with a lot of details in there. But basically, it's already described how you can disentangle the market's risk aversion with the market's expectation of future probabilities. And using this, we can then estimate what expected returns will be in the future.